What's up, YouTube? What's up? Hey everyone, it's your boy Chris Sain here. You want to sell your butt? Yeah, just buy this option course, bro. What's up? Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to see Chris Sain's predictions of Draftkings, the most amazing stock in the world, bro. And then we're going to go look at the financials because I'm curious to see if this stock will actually 2x like Chris Sain said a year ago. So let me go ahead and share my screen. What's up? What's up? So if you go back and search some of these total losers, you see Chris Sain right here says, Draftkings will, what's up? Draftkings will 2x from here, ladies and gentlemen. So this video was made a year ago. Let's actually see the exact date, if I can pull it up. February 2nd, 2021, so more than a year ago. So let's go see the performance of Draftkings stock since that date. So it's actually worse than I thought. So Draftkings, when our fearless hero, Chris Sain, who's such a genius, he has hundreds of thousands of subscribers on YouTube, because why not? Told you Draftkings was going to 2x when it was $63.87. What's it trading at now? $13. Oh my God. Oh, here's subscribers, here's sponsorships, here's all the money in the world, here's Patreon, whatever. You call Draftkings, man. You killed it. So it went public in 2019, and it's basically like a sports betting gambling stock. And it got massively popular during the pandemic because everybody's locked down. You know, what else are you going to do with your stimmy check but just gamble it? You know, don't pay off debt or, you know, something like that. Just gamble it on meme stocks and DraftKings. So make sure I'm streaming. Okay. So let's go look. Actually, I want to see what the genius analysts think where DraftKings is going to go. So here's our genius analysts right here. Okay. They think DraftKings is going to be high of $60 per share, average of $31.79 per share. Oh, it's a 2x. And a low of 16. Actually, this analyst is probably the smartest one. And what do all the analysts say? They all say to buy. It's a moderate buy. Now, I'm just an accountant. I mean, I'm an idiot. I don't know anything about stock analysis. So let's go look at DraftKings Financials. What's up, YouTube? So I like to look at a couple things. First, we're going to look at revenue by revenue growth. So you can see DraftKings here has had pretty impressive revenue growth. 17, 42. During the pandemic, 90, 110. It's growing at a pretty healthy clip. But there's more to a company than revenue growth. You also have to factor in share dilution. Now, they don't actually point out share dilution here, but they show the growth of the shares outstanding. When a share is outstanding, that means it's actually available to be traded by the public. You have authorized shares. That's how many shares a company can give out. Issued shares, if they ever give out a share at any point, it's considered issued. And outstanding is the shares that are actually outstanding, actually traded. Because a company can issue a share or shares and then buy them back and put them in treasury or retire them. Outstanding is where you want to look at. So I firmly suspect, as we dive into the more financials, I think DraftKings is going to have to keep issuing shares. That's my suspicion. Okay, we'll see. Earnings per share, basic and diluted. Negative 0.77, negative 0.4, negative 0.3, negative 3, negative 3. Free cash flow per share, negative. Gross margin, declining. Operating margin. Let's see, what year is this? 2020, negative 137%. 2021, negative 120%. Profit margin, probably because they had some, tax credits or whatever, negative 117%. Holy freaking crap. This is complete and utter trash. Who in their right minds, except for speculation, would buy this stock. Now, if you just like to gamble, okay, maybe DraftKings will have a pump at some point. I don't dispute that. But when it comes to profitability, this company is just losing money hand over fist. And I don't see any improvement. All I see is just massive negative numbers. So when you buy this stock, just know it's a complete gamble. But no, the analyst said it's going to be up to $60, guys. I mean, they went to like Harvard and stuff. Morons. All right, let's see. What is our current ratio? So total current assets is what? $2.7 billion. Total current liabilities, 2.3. So it's over 1, so that's fine. But how liquid are their current assets? Okay, they're liquid. It's basically cash and cash equivalents and receivables. You got to watch out for companies that have a lot of inventory and prepaid assets, because a company may have a good current ratio, which means they can, pay off their short-term debts. But if they have a lot of inventory, which can be illiquid, which, I don't think DraftKings has inventory. I wonder how they factor cost of goods sold in. I don't even know. Or if they have a lot of prepaids, the current ratio can be a lot worse. It's actually called the acid test ratio, where you apply a stricter guidelines for a company's solvency or liquidity. So in this case, I don't think they're going to go out of business within a year, but pretty crazy. Okay. So let's see, goodwill and intangibles. So they have $1.1 billion of goodwill and intangibles. So I don't know if they had some massive acquisition or if that's because of intangibles, some other intangibles, but that's pretty significant. Now, if you remember what happened to Teladoc, they had a massive acquisition of Livongo. And what happened is they did impairment testing and they discovered that Livongo's, the future cash flows that are going to be generated by Livongo, are actually a lot less than its book value. So what they had to do was write it down to its fair value. And they had a massive loss in, I think, the most recent quarter. So this could potentially happen to DraftKings. Whoever they acquired, if it's not worth what the goodwill says it's worth, you have to impair it, which generates a loss. Because basically you overpaid for something that's worthless crap. That's a loss. So they have a pretty significant amount of goodwill on there. So you have to factor that in when you're looking at the book value. Let's see, long-term debt. They've had a pretty massive explosion in long-term debt. So let's see, what about common stock? Okay, common stock has grown. It looks like they're using debt a lot more to finance their capital needs than stock, which might be a little worrying to me as an investor, because as interest rates rise and they have to refinance this debt or pay it off, which it won't be able to unless they issue more stock, they could potentially have a lot of problems on their income statement with interest going into the future. So that's something to keep in mind. Look at the debt growth, 1,515% growth. I don't know. So shareholders equity, they actually have positive shareholders equity. But if they had an impairment, that would decrease that very significantly. God. Okay. Let's go look at cash flow. So in a statement of cash flows indirect method, you have net incomes on the top, and then you add back non-cash expenses, you subtract non-cash gains, and you actually figure out the cash position of the company. Net income on the income statement is on the accrual basis of accounting. It doesn't care about cash. Revenue is recorded when it's earned. Expenses are recorded when they are incurred. On the statement of cash flows, it's all about the cash. So when you're looking at the income statement, there's nothing to do with cash. I mean, I guess it has something to do with cash, but it's not everything. So you can actually look at this company from a cash standpoint. Now, imagine you had a business, DraftKings or whatever. Let's say you have let's say you open a local mom and pop shop, and you have $1,000 a year coming in cash, but you're spending $1,400 or $1,500 a year on buying inventory, paying your bills, stuff like that. You have a shortfall of $500 in cash. Where are you going to get that cash? Well, you can sell stuff in your business. You can take, let's say you can sell your desk. Let's say you have a desk in your office. You could sell that. That gives you cash. Or you could borrow money, or you could issue stock. That's not an option available to a mom and pop shop, unless there's like private equity comes in. But when it comes to a public company, they issue shares. So this company's burning cash hand over fist. And they're also doing capital expenditures. You can see they're buying, property, plant, and equipment for their business. So their expenditures are increasing. Their operating cash flows their operating cash flows are massively down and they're increasing. It's freaking horrible. Okay. So let's see what else they did. Acquisitions. So it looks like they spent $178 million in 2020 to buy some businesses, and then 64 in 2021. So they're financing this either through debt or stock issuance. But it looks like the vast majority of their money is being used to sustain the business. Because look, they issued $1.2 billion of debt in 2021, but they didn't really use it for, it looks like, anything except probably paying their bills. Because you go back up, you say, okay, they went $1.2 billion in debt. Why? What are they using the money for? You go back up and you see, okay, they had a little acquisition here, $64 million. They bought something else for $42 million. What about the $101.1 billion? Where's that going? Well, that's probably there to help pay for their operating cash burn. Okay. I don't see what else they're spending that money on unless they had some kind of acquisition plan, in the first quarter of 2022. I don't know, but that really concerns me. So overall, I just see a company that's going into massive debt right as interest rates are rising. And I see a pretty healthy amount of goodwill on their balance sheet, which if they made a mistake, that's bad, okay, because they have to write that off. And then you go look at the income statement, and they're just losing money hand over fist, negative 100% profit margin. So buying this for anything other than a speculative play is ridiculous. There is nothing that justifies this company from a financial basis. Let's see, interest expense. Let's see, it's really not negative interest expense income. I have to look more into that. Interesting. What else? So we go back to the analysts and they say, oh, high of 60. Like, well, I don't understand what they're looking at. What are they looking at on this income statement, balance sheet, or statement of cash flows that indicates to them this stock could freaking 4x from here? Especially with this environment we're getting into. Look how much the market cap's been cut down. 2021, at the end of 2021, it was $21 billion. Now it's $5.9 billion. That's a nice 2x there, Chris Sain. Let's see. Enterprise value, massive decline. Price to books, massively declined. And a big part of that is goodwill. Debt to equity. So they're not in massive debt, but I could see that growing into the future unless they issue more shares. Honestly, if they're worried about debt and interest, which they should be, as rates are rising, they're probably going to have to issue stock to compensate for their negative operating cash flow. That's my opinion. We'll see what happens. So this company's freaking hot garbage. Holy crap, man. Let's see how many fanboys are triggered in the comments. But Chris and Sain said he just made $200K trading Tesla. I'm sure he did. Let me guess. Is he even showing his portfolio? What's up, YouTube? What's up? Yeah, here's how dumb Chris Sain is. Chris Sain said Draftkings was a buy at 34, but is not interested at 10. That's an interesting analysis there, Chris Sain. Everybody said Draftkings was going to moonshot. Yeah, moonshot to the freaking truck stop. Draftkings running on online gambling company like Trump Atlantic Casino. Yeah, I mean, and there's got to be tons of competition in this industry. I mean, a freaking gambling app, how hard is it to make one of those? My grandma used to take the bus up to Atlantic City back in the day to play slots. Is she using DraftKings now on her cell phone? Chris Sain is a scammer? No, he's a genius. DraftKings is getting a 2x from a year ago. What a freaking loser. Oh my God. Me, Kevin, likes DraftKings. Of course. They lose $2 billion a year and their market cap is $5 billion, massive share debt. Yeah, they're going to have to issue shares unless they go into more debt. There's only two ways you make money for your business. Well, three. You can sell your assets, which hurts your long-term growth. You can issue stock, which dilutes the shareholders. Or you can go into debt, which is bad as interest rates are rising. But whatever. I'm a moron. When they sleep, we eat, yo. He's such an idiot. This stock was as high as $77. Jesus Christ. Me, Kevin doesn't know about balance sheet. Teach him about accounting stuff. He doesn't know what goodwill is. I don't know. Maybe I'll charge him $1,000 and we can do an accounting lesson. I actually have an accounting tutoring site if you want to pay me $70 an hour. You can't even play DraftKings in Vegas. Anyway, that's it. DraftKings is hot freaking trash. Have a wonderful day. Cheers.